Welcome everyone from wherever you are around the world. It's a real privilege to have this opportunity to share a passion for what you do day to day. Before we start, a bit of housekeeping. As you're aware, you are all on mute. Would you please stay on mute during the presentations? You can use the Q&A forum at the bottom right-hand corner to ask any questions you may have throughout the presentation. We will circle back and answer those questions during our formal Q&A process towards the end of the session. We encourage all and any questions, please, today. Also take note that this webinar is being recorded and we will share this recording with you following the session. This series investigates how a shift to values-driven advice will drive economic return for practices, explicitly looking at pricing, advice, and bringing to life the intangible value advisors offer their clients, so they can see it as an investment to live their best life. Today, we are going to deep dive into valuing advice and how to create the confidence to charge for the incredible intangibility of what you do. My name is Santiago Burridge and I'm the co-founder and CEO of Lumiant. Today, I'm joined by Rob Jones, co-founder and CEO of Peloton Partners, a leading business pricing expert in advice, and Ty Cockle, CEO of Financial Freedoms, a leading financial planning practice based in Melbourne. Welcome, Rob and Ty.
Financial Foundation, Santi.
Thank you, mate. Sorry. Let me set the scene first as it relates to the difference between charging and valuing advice. There have been three main models I have seen across the global industry when it comes to charging advice. One, a percentage fee. Two, a hybrid where a percentage is charged for caring for wealth and a dollar fee for caring for life. And pure dollar fees that always seem to look a little bit awfully like percentage fees. But before I unpack the ethical debate around these structures, let's address the elephant in the room as it relates to pricing, particularly in Australia, that independence is somehow linked to it. In Australia, Section 23A of the Corporations Act states that to be able to use the term an independent financial advisor, you must not receive commissions from a product issuer. You must not charge asset fees to a client. Based on guidance from the Australian Securities Investment Commission, this provides also precluding financial advisors receiving a percentage fee from administration platforms, typically known as wraps, when describing themselves as independent advisors. What has frustrated me for so long is that it's the actual banks that wrote Section 923A. And they did this to help ensure our industry could never rise up to challenge them. The Financial Services Council, funded by the banks, worked with the government to define what we now have as a ridiculous measure of your ethics. Why is how we charge linked to independence? Surely independence should be defined by how I am paid or if I sell an in-house product. If I receive any remuneration that the client does not pay in the US, I am deemed to be independent. But if the client only pays me, I can act in their interest to care for their wealth because I receive no additional remuneration for that advice. I can care for my client's wealth with no other paperwork. Indeed, it is not how I charge, but how I am paid that defines my ethics. And if I choose to be charged a dollar fee or a percentage fee, how does that conflict me? If you think it does not conflict me, if you think it conflicts me, as I am encouraged to put more clients into a portfolio, then why do dollar fees look awfully like percentage fees when you sum them up? If that cuts too close to the bone, please stop for a moment and challenge the prism you see this world through. Advice is about serving your client. It's not about selling. If I serve my client and sell them nothing, I am much more than an independent advisor. I am a professional advisor. Where did we lose sight of the fact that we are here to serve, and serving requires structuring an outcome that aligns the client's needs, not ours? When you go to your doctor, do you think they're sitting there wondering how they could capture more of the margin or create efficiencies by selling the same thing to every client? It's nuts. When I go to my doctor now, their technology has gone through the roof. They can pull up everything at the press of a button, everything we've ever achieved together, and every little detail around my life. But our industry continues to do everything it can to ensure you cannot become the profession you deserve to be. I cannot pick up a publication in Australia that doesn't talk about managed accounts or separately managed accounts. You cannot meet a platform without them telling you that you will gain efficiency if you sell the same stuff to every client or build, at worst, in-house models. According to them, selling every client the same thing, as long as you don't charge a percentage, makes you more professional. I'm afraid I have to disagree with that premise. Further, there is no evidence to support that selling every client the same things makes you more profitable. As Rob will show you, we continue to deliver profit margins that are way below what your profession deserves. I believe that relates to the fact that we are focused on compliance and product sales, not the customer experience. Technology has not supported advice, yet it continues to support product sales like automating ROAs and associated compliance. As I said last week, a profession serves, not sells. And to take the mantle of the #1 profession in the world, we need to step up. We don't have better products. The game in town is now about above the line advice and helping your clients lead their best life. It is the only outcome that matters. That is what needs to change. And we're at Lumiant intent on solving it. We want you to be the noblest profession in the world, where you know more about your client's life than your doctor. Today's session is about valuing advice and giving you the practical steps to charge the right fee for the client and the business. We hope it helps you become a profession you deserve to be known for. Rob, over to you, mate.
Thank you, Santi, and thanks for that start. Can you see my screen or not?
Yep.
You can? Great.
Oh, sorry, not your screen, buddy. I can see you. Sorry, buddy.
Oh, sorry. Let me just go back to where I need to be, which is right there, and then I'll fix all that up. Okay, everyone should be good to go. Can you see it now, Sandy, Ash?
Yeah, mate.
Fantastic.
I want to whack it into presentation mode. There you go. Perfect.
She's in presentation mode now. So before I kick into it, I just want to extend my also thanks for all of you giving up some of your time to listen today. Sandy's hit you with the heavy stuff. I'm going to hit you with some light humour and a process that I'm really proud of and we'll be going through with you. And I'm also absolutely delighted to have Ty Cockle. I'll let Ty do an intro to himself a little bit later on after I finish my bit. And that's going to be a fantastic sort of Q&A session with someone who's been there, done that, so to speak. Last week, we talked about above line, below the line. We talked about the value of advice. I'm not here to sell Lumiant, as I said to you last week. I endorse a process that opens the minds of advisors to the value that they deliver. And I'm going to try and give you a process today, a process that we go through to help advisors to unwrap and unpack that value and then put it back together again without it being constricted, which annoys the hell out of me when advisors constrict their value, because the minute you do, you constrict price. The minute you constrict that, you're there not for the right reason, and it's not going to work. I talked about a simple equation last week, this notion of, which I believe in absolutely wholeheartedly, discovery and maintenance of a right fee for a client for that next 12-month period in the Australian context, but also right return for the business. Never elevating one over the other. You elevate yourself over your clients, you've got a classic imbalance. You elevate clients over yourself, you've got a classic problem, structural problem within your business. I've seen too many firms, the stresses, the tensions that creates. I'm over the fact that, for 40 years, this industry has adopted pricing principles and profiles that have no meaning or relevance to tomorrow. And as Sandy said, it's got nothing to do with ethics at this point in time. And don't throw the same at me, because I wholeheartedly agree with what he has said. Whatever I object to and what you'll see to today, it is based on established fact. It's based on logic. It's based on precedents. It's not based on me opinionating for the sake of opinionating and having no balance to that. And I hope that shines through. So I've got you for about 20 minutes or so before I sort of do this Q&A thing with Ty, and we talk about how change can happen. And this is what it's about. It's about change. So thank you again for joining me, and let me sort of get straight into it. And the first thing I want to say, if I can, is to shine a light on a problem. And I know I did a little bit last week. So I want to give you a snapshot of the 100 or so firms. We're actually up to 120 firms now, so the numbers are a little bit out. But this is just a classic table of a problem. Now, it's not the whole problem, and it looks all about financials. I get all that. But a lot of it is. A lot of it stems from a P&L being out of whack for too long. So the profit and loss statement of most firms has not changed in its construct over the last 20, 30, 40 years in this industry. And you can see the problems that is now that permeates. So just this gives you a classic snapshot here. So let's say the firms that we've looked after, the firms that have come to our door, this is what they're generating. These are their numbers. It's not mine making them up. It's their numbers. So there's about a 21% profit margin, around $40 million of those firms. But let's break that down a little bit further and isolate some of the issues. Upfront non-recurring revenues, about 19 million or 10% of that. So that's good in one sense. That's growth, that's new business stuff in there, but it also has some historical product-linked revenue that's been filtering out now. But this is sort of a group of clients over the last 8 to 9 years where some of that product was still in their numbers, because at that time, that was what life was about. There was platform income there. There was investment income sitting in there related to products and bits and pieces. But when you actually pull the covers back and do this exercise well, you can see what the problem is. So profit attributable to the ongoing fee that's charged clients, where most of the ongoing expense is pointed at, is about 11% in these firms. That's a problem. That is unsustainable. It's a very, very, very skinny margin at the end of the day. So yes, that's a problem. This is a bigger one. And I talked about it last week. The fact that clients have been paying, in some cases, 300% profit margin on what they should be paying, well above what they should be paying. And then the other side, 200% negative. That's costing us. So we're not here, and I'm not here to tell you to ramp fees. And if anyone ever thinks that, then you've got it wrong. We're here to establish that framework to reach that equation, that simple equation of right fee for client, right return for the business. Nothing else matters. The reason that there's a plus 300 or a negative 200 is purely historically based pricing models that haven't changed, haven't adapted, single factor typically, whether it's fixed fee, hybrid or percentage based, doesn't matter. But they are typically single factor pricing models, and they are ill-equipped to price the complexity of clients, the value of advice, and the services and regulation and legislation that keeps getting thrown at you time and time again. So I want to push that negativity aside and focus on your value and focus on and give you a sense of how we go through a process of pricing that. And this takes us a long time, by the way, guys. So it's not, I'm going to do it in 20 minutes here, but it's normally a 3, 4, 5 month exercise. If you think you can do it quickly, if you think you can grab a group of consultants to tell you that do a course today and reprice clients tomorrow, well, I've been living in this for 8 years and it's all we do as a business, actually. And it still takes us quite a while to get to it. And I want to show you the reason why it does and the value that creates when you get it right, so that you can understand the process and do it yourself. Do it yourself. So I mentioned last week again that one of the reasons that I really object and have problem with prior and historic pricing models at a single factor is because, quite frankly, it's by fluke and by accident, not by design, that these pricing models have been right. Because we price an individual client, we can see what they're currently paying, we know what they should be paying. It's a simple mathematical equation to have a look at the difference, and it's astounding how inaccurate pricing has been. It's not your fault, it's the fault of the historic model, as I said, not keeping pace. This was a business that I was involved in, and it's also the businesses of the clients of mine. So my own financial planning practice, I had the privilege to lead and owned a small part of it at the time. This was us. So I'm giving you a trace back through 20 years when I first started in this industry 20 years ago. We had a flat percentage of FUM. We then moved to a tier percentage of FUM because we needed to account for higher balances, and we felt that they might have been paying a little bit too much. We then moved and tried a bit of a combo. Let's have it both ways. Let's do a fixed fee and percentage-based fee. All of this sort of stuff was swirling around as we were attempting to try and understand how to price advice accurately. We then went into segmentation, and many of the firms that have come to my door are pretty much in those 4 boxes. So fixed segments, and let me talk about that, because a lot of firms go, hey, I'm charging a fee for a segmentation. Well, really, to be honest, guys, all you're doing is, again, pricing the wealth of clients as a single factor. If they're paying 15 grand as a percentage, let's charge them the same fee fixed. Let's impose our version of the service profile on top of them, give them 2 or 3 meetings a year, even if they don't need it, but because they're paying that much money, we think we have to. That's ridiculous too, okay? It's all ridiculous because it's inaccurate. Service value complexity pricing model. Don't care what you call it, but an adaptive, progressive, iterative pricing profile and model that can change with your circumstances as a business owner, as advisors, and also change at the client level as well. That's the alignment you need. That's the future, not the past. And that's what I encourage all of the firms that I work with to do, because that will discover right fee for both the client and right return for the business. Quickly, Peloton curve. And again, I'm going to move through this fairly quickly because I've only got that 20 odd minutes. So I apologize for that in advance, but I hope you pick up the theme here. So this is just an illustration, if you like, of the problem. So we've just put about 8,000 of the Peloton clients that have come to the door. So clients of our firms, individual family groups, whatever you want to call them, or households, as Lumiant and Santi often talks about. These are the households, right? So on the vertical here, you've got fixed fees historically, and then on the bottom, you've got FUM and related complexity. And often the pricing models, no matter what, the more money someone had, the more complex they seem to be, which is not right. It's not right to the point where we've gone through now and priced those same 8,000 clients individually. And 50% of those clients are above the line. 20% end up below the line. Only around 30% are on the line. So again, to illustrate the point of inaccuracy, this is a classic case. So if we convert a business to this form of structuring, not that we're trying to hit 50, 30, 20 perfectly, but what we end up with is pricing and delivering a profit of around 35% on the ongoing business very consistently, which means it's not plus 300% or minus 200%. It's right for client, and it is definitely right for business. Make no mistake about it. Here is a firm that we've worked with, a quality firm, and this just illustrates the point of the imbalance. Now, fantastic group of clients. We've capped 5 million in FUM, just to give you an example. We've capped fees at $30,000. You can see where the cluster is, but you can see the illustration of the issue over on the right-hand panel. Too many clients are below the line. Well below the line. So whilst this business was profitable, it was around that 11, 12, 13%, barely sort of, it's there, but it's not sufficient enough. It's not sufficient enough to support the increased costs, compliance, regulatory burdens, and the intrusive nature and the issues that causes us as advisors in our back office. So we can't fight with a lot of that. We're going to work with it, but we've got to take control ourselves. This is about taking control of yourself. So again, I illustrate the point. It's not ramping fees. In fact, this particular business has dropped fees to a lot of clients. It had to adjust downwards as well as upwards. But overall, we got the profile right for them eventually. Takes about 18 months. It's a long time. Ty will also talk about that as well. So this is our approach to it. And often I say to a firm, if you don't want to work with me and I don't want to work with you, then this page is going to define that perfectly, because I'm not interested if I can't convince you of this. And if I can't convince you of this, you're not interested, don't pay my fee. This is how it is. So intangible value, that investment the client is making in themselves, in their future, whatever trigger event got them to your door, it is about the maintenance of those issues. If those issues are still there, if the client came to your door because they were uncertain, they were unsure, they wanted more security, they wanted peace of mind, if those factors are still relevant today, they're likely to be relevant tomorrow as well. But understanding your clients and having a process such as the Lumiant process to be able to plug that, to identify that accurately. It's not sufficient just to say, I'm just here to save money because I want to buy a new home, potentially. You scope the layer further than that and outpours other stuff. This is about identifying that other stuff, elevating it where it should be. And as far as I'm concerned, intangible value, call it a retainer, I don't care. And if the regulator's listening, challenge me on this point. This is the investment a client is making in themselves and their version of financial success, whatever that happens to be for their family. I'd charge the whole client the whole fee if that was the case, if it was that important for them, and whatever the other services are they are. This is important. The second batch, of course, is those physical things, the moving parts. Above the line, intangible value. Below the line, using David Hines' terminology, is all the bits and pieces, the moving parts. Relatively easy for us to be able to price in a pricing framework, but every single firm is different because their costs are different and their client profiles are different. Then we add the third layer, which happens to be structural complexity or additional value add areas, the things that clients will need, not all the time. I mean, the core of financial advice really sits in these two buckets here. Need, whatever drives you to the door, plus the physical components. But then throughout the life cycle of a client, all these other things come into play. Some clients are really complex because of where they've come from and what they've built themselves. Others are very simple in terms of their financial advice structuring needs. But at different times, they need to reach up to more complexity or even down to more simplicity. So being able to view a client through a prism like this and a matrix like this allows you to remain in step with clients, allows pricing to remain in step with the changes of your business as well. That for us is the telling factor. If you want to work, you work to this. If you don't believe in it, then don't do it. It's as simple as that. So this is just one aspect of investing I want to get on. This is a really complex area. This is the intangible value side of things. We go through a process of asking a series of questions of the advisor, probing the advisor's knowledge of the client to get a better understanding of the depth of investment required. This is just a couple of little examples. It's not the matrix we adopt. It's an example of some of the questions that an advisor has to go through. We add a whole stack of additional questions, teasing out the trigger events, teasing out the insecurities the client may have, or their fears, or their dreams, or their hopes or aspirations, whatever they are, to attempt to quantify them. When we can quantify them, we can wrap them into a framework. When we wrap them into a framework, we can make sure that that is always the dashboard that we first have a conversation with a client about. And the very first part of pricing at the Peloton level is all about intangible value. And that's the very first thing the client sees. And I'll show you what they see in a moment. So I want to highlight the importance of this. It is not as simple as just looking at these boxes and going, yep, that's what it is. The qualification is much deeper. It is so important. And the efficiency and the ability of a Lumiant process, and it sounds like I'm flogging Lumiant, but I'm not here to do that. But if it unpacks that blinkers that you sometimes have advisors have about their value, which is one of my pet hates, of course, you take that off and you've got yourself exposed, you open yourself up to that value, and you can link it back to the client time and time again. Sometimes they need reminding. So what do we do first and foremost? We have to go back to the business. What you're seeing in front of you is a real firm of Peloton. It's not someone that's on this call, but I'm just giving you an illustration. They are all the facts of the firms we've worked with. So this firm is in a bit of trouble. Started off pretty well. It was having a good year back in 2015. Things have deteriorated. There have been reasons for that. There's really good reasons for that. If you have a look at their expense line, I can tell you now that as more regulation hit them, they had to staff up and everything else. Growth, they were trying to get some growth. They were getting bits of growth here and there, which was okay. Their problem was they were failing because their model wasn't keeping pace. That was the issue. So you've got to start somewhere. So our deep analysis has to give us a why. The why is, there's many reasons why people need to change, but there is a financial flaw that needs to be established, and that's part of the why as well. Please stop me, Ash or Santi, or even Ty, if I go overboard, by the way, because I get worked up, as you know. So what we do is we establish our targets. Target is important. You know, I had a firm yesterday, a fantastic firm. I think they're listening in. I hope they are. I'm not going to name them, but it's a firm that's been through our process already some time ago. And then they basically gave me something I wasn't aware of, asked me to catch up with them and said, Rob, listen, we've got 2026, we're out. You know, we're not going to do the education. We are wanting to go on our own terms, which is the very first question I asked them. Do you want to go on your terms? You want to go on someone else's terms? We need to backtrack now for 5 years to start a process now. Too often it's too late. But they gave me, that's what they said. Their opening gambit was, we're out at 2026. Fantastic. You've made a decision. Let's see what needs to happen. And all we did was we backtracked 5 years to work out what to do this month. If nothing comes from this process, you don't have to adopt ours, by the way, but whatever you do, start something and get underway. Stop procrastinating. It's not as fearful as you think. So we need to target. We need to have a financial base for it. We need to be able to tell our clients that profit's part of the equation. So that's what we always start with. That's what we're trying to fix with, and every single firm is different. This page is a dangerous page for some firms. And the reason I want to illustrate it is you'll see that we've called lower quality revenue $175,000, and we call it base solvency. It sounds a bit spooky, but all we're trying to do is to peel out the other aspects of income that are unrelated to the most largest expense of a business, to get an understanding whether or not there is a problem with the ongoing fee model that's in place. And if there is no problem, there is no issue to solve. There is no issue to solve. If there is a problem, it's got to be solved. And unfortunately, you pull this apart, and too often we find that the ongoing model is all over the place. Even at an aggregate level, it might be delivering around that, 19 or 20%. And some firms have said, Rob, we're making 35, 40%. From our ongoing model. I say that's great, but do you have clients paying 300% profit over well overs, and your others well unders? That is going to bite you in the backside soon enough if you don't sort it out. So it's not just about a structural flaw to work out whether or not the ongoing model is making you something. It's about the mix of clients that are in there and the profiles and what they're contributing to that is becoming an emerging significant issue. And if you want to hit FASEA Code of Ethics Standard 7, services and fees, fair, reasonable, represent value for money. Well, good luck if you can't. Good luck if you can't satisfy that. We were recently launching a new business, and I asked the advisors, fantastic advisors, good experience, put each of them on the spot, not to upset them, But you tell me, pick out a client, I'll pick out one of your clients. What does the business make on that? Do you have any idea? And of course, they're not in the head. They don't know. They just don't know. And we've got to get better. Our answers have to be better. We need to be able to say, yeah, we do make a margin. In fact, we make a 30. Our objective is to make sure that we're making at least a 30% profit margin, between 30 to 33% on every single client we work with, including you client who's standing in front of me. Now, clients don't object to that, okay, at all. In fact, they want you to be successful, not ridiculously so, and they don't want you to be on struggle street either. But we've got to be prepared to have some of these conversations. Next step, we start unpacking the firm slowly but surely. Let's work out the core services they provide, which are unique, which are not unique, actually. They're actually quite consistent with the majority of firms, but that's where it stops. There's always a core, and then there's a whole stack of other things that sit outside of that. But we've got to start this process of slowly unpacking. What are the qualifications of the business to be able to provide the services they say they can? How far does that stretch? How far does that elastic go? Are they capable of going into areas that, and we've got one firm at the moment that right now can actually service clients across 23 different aspects, quite significant. The average Peloton firm is around about 16, 17. And of those 16 or 17, there's a core group of about 7 to 9 or 10 services that are core to the firm, where the majority of the moving parts are. But then there's also those other bits and pieces you'll see in a moment. But there's one firm at 23. So they can go into really, really complex areas because they're qualified to do that and have the expertise internally to do that. And we uncover that. That's a value add point. So we need to uncover it. So it takes a while for us to be able to do that. Then we need to look at a depth analysis, which is on the right-hand side. What's the current depth of clients that are in receipt of that service according to the firm? First step, very basic. Another aspect is we're going to dive into each one of those areas. So if you just look at them, there's 13 or 14 listed there, which is only the first aspect of it. That often swells to 17, 18, as I said. But at the moment, that's what it is. Then we have to go through a decision. An advisor has to go through a decision then, based on some questions that we want to ask the advisor in order to determine whether or not a client is of minimum complexity or maximum complexity or moderate complexity, whatever the case may be. The way that we typically do it is that we can, and this is just one service, by the way, is a series of ascending questions. And the more depth and the more complexity of that individual client referenced in the questions that are posed to the advisor, the more yeses the advisor gives. The more yeses, the more time, the more cost, higher fee, plus profit. It's simple in that sense. But the minute the advisor answers yes to those questions, straight away, if it's ever brought up by the client, well, what are you doing here, or what value are you adding there? That advisor can go straight into it and know and understand. And I know it's a little tiny here. It's not meant for you to be able to see every single thing, but they can go into those specifics. This is what I do in this area for you for this next 12 months. These are your needs and requirements there based on my assessment of your circumstances. Go through that, repeat through all of those different areas. And it'll pull through the right fee that client should be paying for this next 12 months based on the advisor's assessment of those questions that are asked of them to reach a determination. We call it elections. And then just to make it even more complex for you, but in order to make it even more simpler, we then need to go and test a group of clients with every firm. And it takes us 4 or 5 versions of a pricing framework before we go launch date. That is the one that's right for this business. And why? Because now we're going to bring it to the client. We're going to come back and look at the client now as a breadth of clients across the profile of the business based on its smallest clients at the bottom to the client at the top, whatever the case may be. We then need to ask the advisors a series of those same questions to work out mathematically what decisions are they making, and have a look what's going on here, because this is an actual firm only done 6 months ago, so it's fairly raw. The assumption is if a client's at the bottom that all of their needs are minimum. This business, by the way, has 383 clients. This is only one. We called a client group 15, where that happened to be the case, which is quite rare, that 7 of the decisions the advisor made were at a minimum level for that client. That's all they're at on the complexity scale. But I find firms that, I could get up to $6,000 per client, and the firm is still judging them as minimum, but they're actually not. Look at all these numbers starting to appear. When you break into it and you go into it with a bit of detail, with the right framework wrapped around it, you start thinking more deeply about the client, and you can start pick out differences. Equally at the top, not every client, just because they're paying $24,000 historically, and this is all their current fees were, by the way. So this is not our fees, this is their fees. And this particular client normally was priced at around, would have been maximum for everything, but they're only maximum on one, as a matter of fact. Why? This client is an allocated pension client. They've gone through a complex lifestyle change in terms of their advice needs. Now it's a fairly predictable rhythm. Why are they still paying a fee that actually is delivering the firm more than 100% profit on them? That's danger. That'll be exposed in time. That's payback time. We don't want that. This illustrates the fact that not all clients are either simple because they're paying a bit or they only have a little bit of money saved up, and not all clients at the top end that happen to be successful in life and have done well over the course of time with you are necessarily complex all the time. But just look at the variance. This variance is money. This variance is inaccuracy compared to what a single factor pricing model does. It just proves the point. I know it's anal, I know it's a lot of work, but you've got to get down and get dirty before you can get out and get free. Then we pull it all together, we repatriate it, we build it for the firm, we create business rules in order to run the project, to guide advisors through these decisions they're making. But at every stage, what we're doing, I hope, and Ty will either agree or disagree with me, is we're trying to expand their view of value. We're trying to have them answer more questions when I ask them, or give me more when I say, what is your value to your client? What do you say? What do you say to a new client that walks through the door? Not having to go at your advisors, but most of you cluster around 4 or 5 things, and it sounds nice. I look after I work out what my clients' objectives are, and we build a strategy for them, and we help them reach their goals. And there's cash flow, and there's tax, and there's investment. Sounds fantastic. It sounds fantastic at that level, but it doesn't tell me exactly what you're doing deep down inside the business for me and why I'm paying a fee that I'm paying to you. This enables you to be able to do that, enables you to go down a bit further, scope it out more, so that if you're ever propped, whether it's regulator, your boss, yourself, your client in particular, you're ready to respond. That's what this is all about. Please understand that. So once we've sampled a group of clients of a firm, once we started the first version of the model, once we get a bit of a sense of the decisions the advisors are making on those sample clients, we're able to start to project some outcomes. Not perfect, not every single time, but we're able to start distilling down where the gaps are. And in this particular case, we had a gap here of, in our world, based on prima facie, there's all the work we've done to date, that there was about a shortfall of nearly $400,000 to that firm. That was the difference between their profit at 5 or 10% and 30 to 35%, which is very reasonable. And that's what it happens to be. It's a large number, I know, but in that number is clients going down, by the way. So significant downward as well as upward, and some sideward. It just depends on the process. But what we're able to show them and demonstrate to them is that that is what could happen. That's what's probably sitting in there. That's where the issue is. What does your client see? So in our world and the firms we work with, this is what they see. They see everything, right? So they see exactly the services that relate to them, and have a look what's up top. Intangible value, what really matters, the investment you are making in yourself, client, in your sense of financial security and financial well-being, financial success, financial need, whatever that is, financial legacy, financial succession, passing through to financial philanthropy, whatever it happens to be. Whether you have got a really poor knowledge of advice, whether you are time poor with a great understanding of complex financial matters, whatever your need is that shines out first. And we put a price on it. You bet we do, because we've gone in deep and we've worked it out, and we've been able to distill it into a number. So the client sees all this. They just see the range of fees that have been worked out for that business for the next 12 months. They see the assessment the advisor's made. And if they want to ask a question of the advisor on any one of those things, why am I different in these areas? Because you're not the same for everything. And we're not forcing upon you a service model that doesn't relate to what you need. And it certainly doesn't relate to what you're paying, or previously were paying. This is what you need to be paying, because this is the areas we're scoping for you for the next 12 months. And it pulls through a fee. There's the fee. The client pays the fee. Simple. The difference of doing nothing, the difference of taking action. I showed this to you last week. This is this same firm, by the way. If they were listening, they probably wouldn't care. But again, I'm just illustrating the point here of doing something or doing nothing, and the important impact it has to your business across these important metrics that we too often forget, because we're so focused on the intrusive nature of regulatory and legislative environment, which I'm sick of talking about, and I'm sure you all are, or compliance and licensee firms having a crack at you about everything, and you're trying to get your head above water, and now we've got even more change thrust upon us. But the thing we can control is we can control our own destiny and outcome here. If you're not growing, you're going, and either of those going or growing phases are absolutely legitimate and important. but start something, change something. Don't have an old model determining outcomes, because it's going to stuff you up. And I want to take you to valuation. Now, we've done over 600 valuations as a business, a lot, seen a lot of firms. I've personally done a number of transactions when I was doing a bit of M&A as well. I'm not here to say I'm an expert on that at all. But when I do a valuation for a firm, we do three things. We need to do three things and have a look at structurally what's really going on here in this. There are three formats. There's a net present value of the cash flows. There's an EBIT valuation at a multiple, which we determine based on a stack of other parameters that we're guiding the firm to understand. And then we're doing this recurring revenue thing, which still lingers around, or sometimes a broker will tell you, you'll be able to get 2.5 to 3 times. And in the end, structurally, the deal forces it down to somewhere around 2 or 2.25. That's the nature of the beast. But have a look at what the real issue is here. Look at this. Their multiple of EBIT on that particular business is 2.9 million and 3.6 is 2.25. So I'm a buyer. I've bought 13 firms in my life, in my career, for the people I've worked for and worked with. And the very first thing I do is I go and do my calculation on EBIT and what's really going on in that business after I normalise their expenses. The owners are going, well, I'm worth 3.7 million because I've been told it's 2.25 times. There's no chance in hell I'm going to do that. If I overpay, I'm never going to recover my money. There's too much more risk. I'm going to put conditions around all sorts of things. So this is the facts, and the facts speak very loudly in this particular case. So what are we trying to solve here? We're trying to help out, not just, it's not a cash flow thing either. It's not just to add some more money into the capital value of the business. It's putting that floor under the value you're providing and making sure that that's never overreached or underreached. And it's allowing advisors to do what they should be doing, and that is to talk openly about their value. It encourages new business. It's better for new business if they do and stop constricting themselves, and it helps them to meet those requirements. So this is this same business. That was their valuation at the time. This is the same business now. And all that's happened is on that do nothing, do something page, but have a look what's happened. All that's happened is now is a greater improvement in their multiple of EBIT because they're doing the same things. It's just been priced accurately. We've gotten rid of the clients that are paying way too much have come down. The ones that are paying way too little have come up. Yes, you're going to ask me about affordability. I gave an example last week and I can deliver 20 and 30 of those. But this has a very, very high level of success with a very, very low client attrition rate. Ty will talk about his own client attrition rate from doing this. But this is what the objective should be. This is your planning if you're going, or even if you're growing, to realign that, to start forgetting this recurring revenue thing that people are buyers aren't interested in anymore. But if your business is profitable and it stacks up, you're going to command the value of your business that you should every single time. And no one's going to take it from you because it's there for the taking, and it's there up front. So I just want to finish on that point that, perhaps I've been criticised in the past for saying, oh, well, all these people do consultants tell you increase fees. That is garbage. That's if you hear that elsewhere, well, come to someone like us and we'll realign your thinking. Don't come to us if you just want to make money. This is about realigning your framework to the complexity of your clients, to the complexity and changes of your own business, to the fact that rarely do your pricing models ever keep pace with your own expenses that keep rising in your business. And it's about getting into this mindset of doing this repeatedly so that it becomes a really natural, fluid aspect of your business. And it puts a floor under your value, you bet. It helps you to meet those regulatory hurdles that, we shouldn't be focused on. We are too much, as I said before, but it actually improves the quality of your business. And that's what we're interested in doing. So I encourage you to do something, and that is just to start. Is that my time up, guys?
Done well, mate.
I think it's my time. I think I've hit the 20 minutes, have I?
You nailed it.
I'm going to stop share for a moment because I've spoken too much. I just want to briefly introduce Ty and let Ty talk to himself. And Ty, thank you again, mate. It's been a privilege to work with you the last 2.5, 3 years. Thanks for coming on. It's not here to try and blow wind up a process of ours or anyone else's, mate. It's here to have an open and frank conversation of how tough change can be in a business and the triggers as to why. But I thank you in advance, mate, for joining and being prepared to come on to this. So a big clap to you. I'm clapping. So Ty, tell us about Financial Foundations Australia, or FFA, I want to call it. Tell us about yourself first, and then we'll get into some questions.
So yeah, pleasure to be here, Rob, and really happy to share my experiences with the reprice projects. So we're an advice business with our own AVSL in the southeast of Melbourne. We have 900 client groups, 5 advisors, an operations manager, and 7 support staff. We service both the mass affluent and high net worth. However, our client base is skewed towards the mass affluent, and we see a clear opportunity existing for us within the next 2 to 3 years with business acquisition, as we see activity increasing leading up to the education standards that changes at the end of 2025. You know, our model is our advisors advise, our administrators administrate, and our fund managers manage via our investment committee. You know, with 2 independent asset consultants and an RE, we really focus on our advisors being really well resourced so they can do what they do best, and that's, you know, servicing our clients. We are a big subscriber of David Hines' observations in last week's webinar, and that is, it's so important to systematise the process so we can customise the advice. And I think, you know, the system being part of our business's defence, so we can continue to be on the offence, whether that be continued improvement of the client experience, you know, and continued improvement of our team's experience, to be frank. And this is something we definitely lean into at Financial Foundations. And, you know, Peloton is a prime example of us systematising our pricing piece. Some of my team are on the call today, I think, and the question I always ask is, can we improve our process? Can we improve our systems? And I would say absolutely. I don't think we'll ever be where we want to be. You know, technology and change in the industry moves all the time. So having a mindset that we need to continue to enhance and iterate is an important part of what we want to instill with our team, and doing it in a way where small changes over time eventually lead to big positive changes without daunting your team, you know, has worked for us, and especially in this current environment.
Well done, mate. So actually, I thought you were a bit nervous about doing this. You're a superstar. It comes very natural to you. So mate, let's go back a little bit then, and let's go back to why first. And I know I threw that chart up and we talk about stuff, but I want to understand the FFA why. I mean, I know it, but I want you to talk about it. So I think it was at least 2.5 years ago, Ty, that we got together. And incidentally, Ty's just finished 2 years of implementation. So, but let's go back 2.5 years. What was the why for you wanting to do something different around this particular issue being a pricing framework? Talk me through that.
So I think we all know the tide has turned in our industry, certainly in Australia, and those businesses that are deeply client focused, that are technologically curious with proven tech to drive efficiency, will succeed in the future. So when the tide was turning a few years ago, as we all know in Australia, I felt this was a good opportunity to really rip the Band-Aid off and to move from, you know, our asset-based percentage fee to what's now known with Peloton as our fixed fee, variable to clients' individual complexity and needs. That was fair for the client, but, you know, also fair for our business. And I know that something that you really hone in on, Rob, and has been a really big piece of the puzzle for us. I think the unbundling of our services with Peloton was the real game changer. This exercise reinforced to me that a large cohort of our clients were actually not being charged appropriately. And what I mean by that is they were not paying enough for the work and the value we were delivering. So that was a real call to action, if you like, for our business.
So, mate, we and thank you for that. And I think you said at the time, and it's fair to tell the listeners too, you did have variance in what clients were paying. You did have clients who were paying too much. You did have clients paying too little, as you said, and you had some that, you know, were near enough to being accurate based on your old percentage sort of fee model. And we were, I think I said to you at the time, it's got nothing to do with the ethics of it, had it? It's got to do with the logicness of it, I suppose. So we did that. We got into the exercise, and it's not a cheap one either, Ty. It costs money to engage a process like this, I think you know. So our phase one kicked off with you. It was about getting to know people in the firm. So that was a big part of it, the conversations. Did you get some value from that? What are your thoughts on that? Because that's part of what we need to do.
Yeah, I think phase one was really about, Peloton lifting the hood of our business and really seeing what we're doing and where we can improve. Pricing was definitely an area where we could improve. And you mentioned that process does take time, and I probably didn't respect that as much as what I needed to initially. I was really on your back, I think, Rob, initially to get the program started. But there was a lot of work to be done behind the scenes to get phase one completed, understand our business and work through a model that will work for our clients and our business. So that was, as you said, 3-4 months, that we went through. And,
I had a bit of a look earlier, mate, only because you were coming on board, and I looked at we actually ended up, I think, with 6 or 7 versions of your pricing thing. So not to scare people off, it just, because of the way that you advise, because of your specific cost structures, and there are differences at the advisor level, isn't there? I mean, there are advisors that are very competent in some areas and some that may not be able to expand necessarily in. And there was a little bit to unbundle, but I think it took us 6 or 7 versions to get it right. And I know how much effort you put into that. So thank you. And it was probably painful for the guys to go through as well. But we got there in the end as a start, didn't we?
Yeah, absolutely. And I think, one thing, I've learned a lot of things throughout this process. One thing that I have learned is that, you've got to take your team. This terminology is probably a bit of a cliche, but you have to take your team on that journey. So you have to get them involved and give them the why, as we all know. At a timing point, the team take it from you and they just run with it. So that was a really rewarding part of the process. But yeah, the work that needed to be done in the first 4 months was critical to the success of the rollout.
So we got to that point where, it's good enough to talk about structure and all that type of stuff, but, it's non-threatening at that point because the advisors aren't actually fronting clients at the end of the day. So I hope, and I remember the advisors well, and I know they're probably listening, some of them, and I'm proud of what they've done, but they were at different levels of confidence, mate, I have to say. They were at different levels of nervousness. They were vastly different in those aspects. And we did, obviously, in that period of time, spend a lot of time on the training side. And, I wasn't about telling the advisors to suck eggs, and I hope that didn't come across that way, but it was more so about how to stand convicted. Once you've accepted that the process is working, you can see it actually making sense, but then it's another thing to present it. And I mean, talk me through that. I know we try and script advice for advisors. I know we spend a lot of time going through training sessions and practicing and that. How important has that element been to help the guys have the conversations and defend what sometimes they had to defend?
Yeah, that was really important. I think, the unbundling of our services, which I spoke about earlier, this really assisted FFA to build out our value proposition. It enhances the client's understanding of what we actually offer and the value each service provides. And you'd be really surprised the level of confidence and clarity your advisors get from it. It's palpable. And for new clients, you just think about your existing clients, but for new clients, the unbundling of the services and the associated pricing models is as powerful as attracting clients as it is to repelling clients. I think that's sometimes missed. I think it's really important in our industry, in particular, as some advisors we are doing hours of work with no reward. What this shift has meant is advisors are busy, servicing, engaging, and working with clients that actually want to pay for it. And it sounds pretty obvious, Rob, but a lot of us are doing work for clients and we're not charging appropriately. And we want to ensure our services are valuable, but we also, this is from you guys, we want to make sure our clients value what we do. If they don't value it, that's okay. That's okay. We're not making them stay with us, but what it does mean is that those clients that remain are really engaged, and want to be looked after. And this ensures our advisors, are not getting weighed down by clients that are not willing to pay the cost, which leads to better service of our existing clients that want to pay. To me, that's an excellent outcome.
So in that sort of 4-month process, we happen to have the best analyst/data scientist in the world supporting what we do, which I'm incredibly proud of and makes me look intelligent, makes me look smart. We've also got, now we get to implementation, right? And I suppose the criticism I had it over my own business, and we had a big business, and I don't think we were the best project managers, because project management is a skill to keep things going, to report every single week, and to keep the energy levels up is huge when you're doing this. Because at the end of the day, your advisors had to see every single one of those 600 odd clients. We'll get into the numbers in a moment, but they had to see them. They had to run through a normal progress meeting format. Then at the end, they had to go through the transition part of it, and add that extra 10, 15 minutes tied to the conversation. We have a project manager, thankfully, Elva, and her and Ben being our data scientist analyst, and Elva, our project manager, obviously had to, and she's had to spend, I think she's probably spent maybe 500 hours with the advisors over the course of mapping clients with them over literally an 18-month period. I just want to touch on project management. Should you have done it yourself?
Yeah, that was one of the things we considered early days, and I'm glad. We talk about building, a system or an engine behind everything we do. So our team or my team can take it and run with it and improve it. The engine Peloton have produced, and and I'm sure it's iterated along the way, was critical to our success. So yeah, we certainly we wouldn't have done it anywhere near as well without Peloton. And you might think, changing your fee structure from an asset base to a fixed fee, how easy is that? It's actually not. It's actually building out your proposition, and building out where each service lands in terms of low, medium, and high complexity, and the tools and strategies that Peloton provide have been, invaluable. So
and the conversation side, and mate, look, you led it well, right? So you only had a relatively small group of clients, but I know you jumped in on some of the challenging client conversations that might needed to be had. But if I think about your advisors and I think about their level at the start of understanding tangible value, and it wasn't like every firm, actually, it's a tough one in a way, because we're actually asking them to think about something and have a conversation with a client about something that the client actually gets, but we don't often express. And that's, I think, a lot of this, and it's why we elevated at the top. Has that been, I know we had some challenging times there for a while, but has that been an easy transition for the team, for the guys?
Yeah, I think, my understanding, I am an advisor, and my understanding has obviously come a long way around that intangible, tangible piece. And so often, as advisors, we wash away a lot of, clients' anxiety, and all too often this is not captured in our pricing model. So what an advice business can say in a day, do in a day, this has taken the business or the individual's years to perfect, and this needs to be reflected. And I think, a part of this process, we look at our process, the way we've done it. We've probably repriced, close to 500 clients now, and still a bit to go. But we've maybe lost 14, 15 clients in this reprice process, and again, that's okay. That's totally okay, because we want to make sure the client values what we provide. So 3 to 4% attrition rate, I'm really happy with. And I know you, Rob. I think if it was a lot higher, there'd be a lot of discussions had, on a weekly basis to see whether we need a pivot or whatnot. But our clients obviously value what we do, and our advisors have done really well. And we've really enjoyed Peloton working with us. And I think
but let's talk about that for a moment, because some of that wasn't easy to hear at times. So I think we discussed attrition at the start, and all I could do was to give you the facts of what's gone before you. And I estimated 2 to 3, 4% sometimes of clients might leave. And sometimes they actually leave not just because of cost. In fact, cost is often not the reason they leave. Often they leave if they don't perceive or think they're getting value from it. And sometimes it's not an easy thing for people to hear. And I think anyone gets a bit nervous about doing this, and I often hear it doesn't matter if a firm's in a regional area of Australia or a capital city or what have you. And the notion of some clients being able to afford advice and others don't. Some of the toughest conversations with the clients who can afford it 50,000 times over, and they still want to hammer you on fees. So it's not a case of being able to predict, but you guys lost a few from the numbers. And if you don't mind, let's get into a few numbers, Ty, because you and I just did a wrap up after 2 years a couple of weeks back, and we looked at the performance, right? So I think we hit our targets, didn't we? We got, I think you had what was the top end target we talked about? It was 500,000 or something around there. Where did we end up?
So when we did the work, Peloton, you did your modelling, we did our modelling. And, worst case scenario, we felt like, the services we're providing, were at least 360K where it needed to be, and what service we're actually providing. I think, we're beyond 500 now in terms of the reprice, and we've still got a bit of way to go. Our client base our client base was significantly undercharged. But you bring up a good point before, is around the reprice. It has to be a true reprice, because some clients went down in fee. So if you want your team to get behind this, it has to be a reprice. And quite a few clients went down in fee as well. A large cohort went up because we identified the problem. But that's
the integrity of it too, right? So it wasn't just about the bottom coming up and the top coming down. There were movements all the way through FFA from memory. We lost some clients, yes, but we got through it in the end. And what about tomorrow though? What happens next for you? And I know we sort of had a brief conversation with this. I'd like to think we've left you with something that you maintain from here on in, but tomorrow's a different world. You're going to have different expenses that you and I have just recently discussed, and you might need to update your model and so forth. I think you can do it relatively easy. What's your thoughts?
So from where we sit, like I said before, we're always looking to improve things. We think, we know we've landed on a really fair pricing model. In terms of how this is then, relayed, I think I mentioned earlier in my, introduction about financial foundations, and, the opportunity for us to acquire, like-minded businesses, and to, roll out a fair pricing piece with them as well is really, really big. So, it's exciting what the next few years has to offer, and there's been a lot of learnings along the way, and none more than probably this bigger project that we've done at FFA, and really proud of the team and the way we've handled it, and the clients have received it really well, and most clients they get it, they absolutely get it. Where we did have maybe a couple of issues was those clients that were on a cheap rate, a very, very cheap rate, a cheaper rate than a cheaper rate. And, that was...
You had some special deals going on in there.
Yeah, we had some special deals going on. It's been a business that's been around for some time. And, so we lost a couple of clients in that sense. And it surprised me because, it was a reasonable size uplift. But they've enjoyed the benefits for so many years. We've got to make it a fairer system, and we did that. And probably out of those 14 clients we lost, probably 3 or 4 of those clients were on a ripping fee. There's a case, mate, where
they've probably disconnected from the value of advice. So, you can either say the client sort of, a bit ungrateful, didn't quite get it, or maybe we just need to get a little bit better ourselves too, but you can't win them all. Reconnecting them to value is such an important part of this. But if at the end of the day, you've done your best and they don't get it, sorry, they're not a client. They don't have to be, and they can go somewhere else.
Yeah. So I think, maybe, do you want me to sort of cover off on some of the key learnings potentially, Rob, and how
mate, whatever you like. If you got time, whatever you want to say. But I just, before I finish, I just want to say, mate, thanks. It's your leadership too that did a lot of this, and thank you for that. I think Sandy had some questions for you, but whatever your key learnings are, you go for it.
Yeah, I think maybe you flesh them out, but certainly from where we sit, I mentioned that any reprice needs to be a reprice. As I said, go up, go down, just needs to be what the client, what it's fair for the client and fair for the business. I think having a designated person in the business that serves as a bit of a conduit between Peloton, assisting Peloton with all things operational, is probably handy as well, which has been good. And this one's a big one. FFA financial foundations are a model where we are the trusted partner of accounting practices. So, and where each of them in their own right refer clients to us, we need to make sure you explain to them why, because there are mutual clients, and you want to make sure they understand the why as well. So that was really critical to make sure you cover that off with your referring accounting partners. Yeah. Communication's another big one. I don't think you can over communicate these things with your team of advisors. We have a weekly huddle with our advisors, and it's all about celebrating the wins, but also celebrating the failures, because you're learning from these failures.
Amen.
I certainly failed on a few as well, and I learned from it. So providing that safe space for your team, particularly for the advisors, is okay, and is probably needs to be done. So
I forgot to talk about your failures, actually. I'm meaning to bring that up.
Plenty of failures.
There was actually quite a few. It was unusual. It was unusually high. But look, let's not talk about that in front of these people who are probably bored of that, me talking, that's for sure. But mate, again, thank you. And thanks for coming on board. I know we didn't spend time rehearsing. All I said, I was going to ask you some questions, and you respond the way you want to respond. And people can take that as gospel or not. But that's how we sort of did this. And I really do. Thanks for your time. I know Sandy's got a question or two at you, and maybe about technology, Sandy, I think you said at some stage.
Yeah, let's go. Thank you, Rob. Ty. Got a question from Daniel, and I'm going to actually add to his questions. I think it's a ripper. How many clients does each advisor in your office serve, Ty? And the second component to that for me is what capacity do you think they have, and what do you need to do to free up more capacity?
Yeah, so to answer the first question, we have around 200 to 250 clients per advisor. There's some a little bit less than that because that we're building them. But to provide the advisors headspace, we spoke about making sure our model is about advisors advising, and really taking where we can. Obviously, we are a business where we've got to roll up our sleeves every now and then and do something outside the box with it in terms of advising, but making sure that we really provide the resources to our advisors so they can do what they do best and sit in front of clients. Centralizing things like the investment committee. My advisors are, part of the investment committee as guests, but I'm not wanting them to, make decisions. I've got asset consultants that make those decisions. So really making sure we are providing our advisors with two goalposts rather than point posts as well, is a good way to obtain capacity. And again, that's not something that you can, do overnight and change things abruptly. It's certainly I'll use that word again, a bit of a journey to get them there. But why are we doing this? Well, because it's benefiting our clients. It's providing the intangible piece around sitting in front of our clients, making sure they're in, providing avenues to make them live their better lives. So that's been a critical piece to the model, and it's something that our advisors love doing.
We talked about it last week, but in Australia, I read some information, a survey recently that advisors spend 20% of their time client facing. I was on a webinar in the US with a $43 billion firm a couple of weeks ago, and they're trying to get to 90% client facing. What do you reckon your guys are client facing?
I would say 55,
Okay.
55, 60% client facing. Obviously, there's work around, that client strategically planning and making sure we're doing the right things in developing strategies and whatnot. So, yeah, our advisors are in front of clients more than average. I don't think 90% for us it won't be a case of 90% because we want to make sure we're strategically positioning clients in a way that's beneficial, and creating these strategies and making sure we're doing all the things appropriately takes time, and giving my advisors headspace to do that is really important.
I think there's a good segue question here. Ty, you're the star at the moment. Could you kindly elaborate on your back end support? You have 900 clients, 7 support staff. Could you break down what the support staff cover?
Yeah, so each advisor has their own personal assistant. And we have a junior administration team where they will input a lot of the data, but we're sort of moving to that digital phase now, so that will relieve some of that there. And we also have we outsource some power planning offshore, and we do outsource an administration offshore as well. And we have operations manager as well. So our administrators do administrate. They're not power planning. Administrators are administrating. And our advisors are advising. So yeah, that's the way that's worked really well from us. We think it's really scalable, and I think it certainly has a situation where you can reduce key person risk in the business as well. There's a process behind all of that, and yeah, that's important as we move forward.
Team effort.
Absolutely.
Question from Tamara. Hi, Tamara. How you going, mate? When rolling out the new fees, how was this delivered to the client? Was it face-to-face meetings or annual reviews?
Yeah, really good question, Tamara. So initially it was pre-COVID, so we were doing face-to-face, and then I had a pause for 2 weeks with the team as COVID hit, and we moved our team into their homes. And that was an iterating approach where we sort of decided, okay, let's just wait and see. And then we moved from, okay, we're confident in our ability, our value, we can do this, on Zoom. But we had rules in place where if it was an uplift of more than $1,500 a year, we wouldn't be delivering it because we felt like that needed to be done face-to-face. So that was the first iteration, and lo and behold, the operational rhythm got going like it always does, and we're delivering, most of our clients via Zoom during, we're in Melbourne, so we're all in lockdown, obviously. So there are clients that we're moving forward, and those rules are quite loose now in terms of the amount of uplift. Obviously, we're repricing down, no issue at all. But I think
there's something to be said, though, isn't it, for the integrity of honesty, right? Because it doesn't matter the portal. We've not noticed, and we're a business that most people might think would be tough because you've got to be face to face. But there's been no actual drop off at all. Whether a firm is doing making change, whether it's visually face-to-face or whether it's via what used to be perhaps an impersonal format of this type of delivery. And yet it makes no difference. And I think that's the honesty, integrity of anything. That'll always come through. Client value is, clients have got it. The education is for the advisors, Ty, isn't it? And as I said to you before, nothing of what we did for the client. We actually just did it for the firm and the advisors. The client's the easy bit. Because I haven't had yet a firm that's got a rate of less than 90% success on doing this. And it's not to do with us and the process. It's to do with the fact that they've been delivering great value, and we've naturally tapped in and we know the response of the client. We've got all the data that the client's not the issue. So it's supporting advisors, and the extra 15 minutes it might take to reset this process, which is what we ask every firm to set aside at the end of your progress meeting. We call them progress, not review meetings, as I mentioned. At the end of that meeting, allow 15 minutes to take the client through something really important. And Ty, I think your guys were trained the same way as we train any other firm. Mention this up front to a client. I'm going to take you through your progress meeting. We're going to talk about a whole stack of stuff that relates to you, but there's a very important part that relates to both you and I need 15 minutes of your time to take you through that. Just as important.
Yeah, spot on. I think.
And the other thing is, you're a largest business, right? I mean, we've got ample. There's firms listening now that have just started with us, and they're single advisor firms. In fact, I'm doing a format of this next week. And then instead of getting you on board, Ty, I've got a guy who's on his own with a part-time admin person. And the process is identical. It's just that there is less time in that particular scenario, but it's identical in every single step of the way. And it took us 2.5 to 3 months to get him to implementation as a single advisor. But it doesn't matter the size of the firm, it matters the process.
You know, I think you know, you do all this work evaluating and analysing, and you know, there's at some point there's got to be a leap of faith, and you just got to start. And you know, my theory is, I think it's the JFDI. Just do it. I won't say what the F stands for, but you know, you've got to have a.
What does it stand for?
You've got to have an approach where you just got to get in there and get it done. Once you've confident enough that you've done all the work around the client piece, the team piece, because the team piece is just as important as the client piece. We want to make sure we're improving our team's time at FFA just as much as we want to improve our clients. So that's, yeah, just maybe we'll call it JDI.
Yeah.
So it comes out time and time again, really. It's in the brain. It's in perception. In reality, as Rob keeps saying, the clients will value. No worries tomorrow. Hey, Pete, down from Melbourne too. G'day, Pete. Did the Peloton process result in wholesale changes to your systems and processes, or were they mainly pricing to this point?
So for us, there was no change in our system per se, in how we use Xplan, and so there was no change whatsoever. It was simply just the pricing engine that we utilised from Peloton.
So, and I think it's a great question, because a firm like Ty's is set up pretty well, right? So systems have been well and truly established. For other firms, however, the change in the back office, if you want to look at it from that perspective, is every client is a segment effectively, and you actually reduce the over-servicing issues, and you get the servicing level right. So it actually helps you to resource both now and into the future. And I say to every firm, we're not here to solve all of your problems. We can't solve all of the problems. We're here to hopefully deal with one of the big ones that allows you that's holding you back from resourcing yourself better. But sometimes there are those changes for some firms are quite profound, because it affects their operating model, where they're not as well resourced or well set up as Ty's business.
Brilliant. The questions keep coming in, guys, so I'll keep moving. Question for you, Rob. Is it ethical for a planner with more experience charging a client more for his service than a junior advisor would charge the same client for his service, all other things being equal? Yeah, no,
a really good point. And, here's my answer. It doesn't mean it's right, that's for sure, but I'll give you the best I can. As far as we're concerned, the business advisor is the client, unless you've singled out that there is an advisor with a special level of expertise. And right now, we're actually going through an exercise with one firm where there is a big gap in terms of 1 to 2 advisors in particular, as opposed to some of the others, in terms of their depth of knowledge and expertise. But the short answer is there is no difference. It's the firm providing the advice, and whatever the value is that's going to the client, that value can be quantified, and so be it. So we don't just separate out. However, there is an example of, again, the firm with the 23 services that they can extend to, where there is particular expertise vested in one of the individuals around executive share option schemes, and it's deep. So all we've done in that particular case is everything else is very consistent, but we've allowed for a higher fee relating to that specialisation work that relates to an individual who's the only one in the organisation that's particularly strong in that area because of experience. But that's about it. Otherwise, ethics doesn't come part of it. It's value, it's service, it's expense, it's training of advisors, it's profit margin, it's turning the lights on, it's everything else that is impacted. And a client should bear no more or no less than what their circumstances define. And if they need a bit of extra specialisation and there's one individual that can do it, as we put it to the client, you can either go elsewhere and go to an accountant to get that advice if it's tax related, or we've got someone in-house that's an expert on that and we can facilitate it. Otherwise, it's the same.
But
and you shouldn't be
could be a bit of a
segue,
mate. But I'm not exactly sure to answer it, so I hope you do. Does Peloton have a module for analysis for individual advisors and not at a firm level?
Yeah, I mean, it all ends up. So, and I know at the risk of trying to take in too much time, in those early steps that I was taking you through, we do a heap in the iFocus stage, as Ty knows, in terms of evaluating the structure, right? So how many advisors are supporting, the type of client profiles you need to support, do you need, bringing that into the paraplanning level, the client level, so you can get a profile of a single advisor and what they can support and what they can service based on the type of profiles they look after. But I have to say, this has changed dramatically. Back when I was in my firm and we had a dozen advisors in my firm, and we could do this easy. One advisor, one individual support person and a pooled resource was pretty much what was required, and they could service 175 clients. But because of the type of profiles we were looking after, that changed dramatically over time. And certainly for some of the firms we work with, this equation does not work. So we don't actually have a single standard that fits a nice little thing to say that there is that advisor looking after that many clients with that support, and that's going to tick the box and you're going to be profitable no matter what. It's changed. And it's changed because of what we've just talked about today, about the more complexity that we've had that's been forced upon us intrusively by regulation and legislation. The fact that clients are more complex, their lives are more complex. We're dealing with more variability than what we've ever done before. And those things have disrupted, if you like, a traditional format of you can service X number of clients. Our modelling, what it shows is that it's dramatically coming down the number of clients that an advisor can support in this current day and age, with a real big focus also on that needs and the rationale for them needing to invest in themselves and what that means for that individual client, whether it's a client with 50 grand and starting out or $10 million and finishing out. That has disrupted some of the demographics. So what we typically give a firm is a similar profile of similar firms based on similar size initially. Then we have to drop it into the type of client profiles they're looking after. It's the client profiles that are emerging, Sandy, as a key demographic of a financial advice firm in this country. That's what I can tell you 100%. It's the client profiles. The more we know, the more we understand, the more discrepancy there is. There's no one size fit all metric, but I can give the averages. We do that for every firm to give them a sense of alignment, but then we've got to take it more sophisticated. And that's why we have to take the time to build the things we need to build.
Well, a quick one for you. And feel free to say you don't want to answer it and take it offline, but how do you typically charge?
Me, like a wounded bull. Is the short answer. And look, jokes aside, make no mistake, we make a 35% profit on every firm. Ty, sorry, on yours I elevated a bit because sometimes you were painful, but basically we do the same thing as we ask advisors to do. We target a profit margin based on and it does take a while to set the fee, but we have a standard. Firms can either pay a fixed fee plus a performance-based fee, so for the success of the project and linking that success back to those factors, or a straight fixed fee. And that's the way it works. And the number of advisors and the number of time we have to spend dictates the terms of reference. So there's two things. We do an eye focus. That's an analysis. That's to work out whether or not you need to invest in a process like this or not. It'll tell you a stack of stuff you probably don't know. It'll tell you some stuff you do already know. But I'll do a valuation for you as well. Now, we normally charge 15,000 plus GST for that, as Ty knows. Sorry, Ty, for people like, who come to these sessions, I tend to give them a little bit of a haircut on that. You've had your haircut, clearly you've got no hair, but
Can't go grass on a busy road, Rob.
That's right. And if there's justification after we present that evidence to you and dissect your firm and reimagine it for you, hopefully, and give you a bit of a trajectory, then you decide whether you want to invest in this process or not. And you're not going to get out of it cheaply. But having said that, Ty, if you don't mind, I'd like to think that the value that's been added to your firm has the investment. It's ridiculous. You can't go and buy a $500,000 clients in this country at this point in time, or recurring revenue that are well set up like yours are now, and hope to buy that for anything less than $1 million in the shelf today. And you didn't pay anywhere near $1 million. So the investment is the least amount of the issue. And again, when we do our project profiling, we look at how firms implement this. We know what's gone on before. We're able to tell you exactly when you'll be cash flow positive, based on the fees you've got to pay to us and when you will cover those fees. And I don't think yet, so if there's a firm out there that's listening, you want to challenge me on it, that have gone through this, there's not one firm yet that's had to take a haircut on their distributions. There's not a firm out there yet, I don't think, that has had to borrow for a Peloton's process, because it actually pays for itself. It just takes some time and you've got to pay to play. So if you don't view it as an investment, don't bother.
Perfect. Quick one, Ty from David in Melbourne. G'day, mate. Any clients that have come back once they've realised how good your service is?
Yeah, that's a really good question. I actually, 3 weeks ago, we had one that's re-engaging. Now they haven't signed yet, but certainly we're going to go through the SOA stage again. But yeah, so you're starting to see some of those coming through, maybe one or two. But I'd love to connect with you in maybe 12, 18 months time and provide you with a bit of an update, because I have no doubt that, our offering where we are, we're really confident that we add value. I have no doubt that those 14 clients that have left us, I'd be surprised if 10 or 20% don't come back.
Cool. I got one question. I think we're at the question that I would like to ask both of you, really. I find listening to you, if I could dumb it down in some way, it's almost like listening to the difference between a founder who's got a job and a founder who's got a business. And what I heard when listening to Ty was just this business centric, and stop thinking about me, the ego, and the reason why I joined this industry is because I wanted to manage money. In fact, what I wanted to do was serve more people and create a better community. Is there some truth to that statement? Have you experienced any of that in either of your experiences today?
Yeah, I think, so I had quite a large client load, probably 5-6 years ago. So I was in that headspace of advisor, trying to manage a business with my other partners. There was a time where, you have to step out and give it the helicopter view. And that helicopter view was, again, I talk about iterations and whatnot. That's been a process. Right now, my client load is sitting at around 30 clients. And that was in the hundreds, 5 or 6 years ago. So yeah, it's definitely something that I wanted to do to ensure the longevity of the business and the client experience, because we're just really busy looking after clients and trying to manage the process and the business behind that. That was difficult with myself and others.
It really made that transition from having a job to running a business.
Yeah, I think that's where the aha moment came from me, and I get a really big kick out of watching people grow. That gets me up out of bed in the morning. And yeah, I get excited about that. And it's been a good journey.
You had to stop doing the thing that you did, which is why you joined this industry in the first place. You had to stop doing it. And that would have been a challenge to your ego too, at some level.
I still like to be really involved in terms of, the wins that our advisors have, and I get enjoyment out of that. So I think I get exposure to it anyway, because I see my team doing the job they're doing, and that's my exposure. That's all I need.
Oh, that was rehearsed. That was rehearsed, I reckon. That was
that was not
beautiful.
Rehearsed at all.
He just summed that up, didn't he?
Is there anything you want to add to that, Rob, before we sum up the session?
Look, no, I other than thanking Ty, mate, for your time, I do appreciate it. If I could just say to everyone who's listening or still listening, just push start. Don't look at your business through rose-coloured glasses. Bring a bit of honesty into it and make change. If you want to make changes, you've got to kick it at some point. And I think some people hold back that the most. I had someone said to me recently, and it was a pretty honest appraisal of an advisor. Rob, I've heard you and what you go on about, and some of the people, I've seen your clients. I've spoken to my friends of your clients, and I see what they're doing, and I've been embarrassed to come and present my business to you. And I said, well, why? I thought it was ridiculous, by the way, that this lady said this, because she's super smart and everything else. But I got it wrong, because for her that was important. She said, I just, I've been working hard. I don't know if I want to hear what you have to tell me. And we've recently connected after that to say, well, what do you want to do? Do you want to keep going and making the same mistakes that you've actually said to me you're making, because you've seen and benchmarked yourself even, and that's the case? Or are you going to do something about it? Because that going or growing, guys, is an important decision that needs to be made. If you are going, you've got a time frame. If it happens to be 2026, like it is for many people, start now. If you're growing and regrowing, start now. Put something in place that makes sense, please, whatever it happens to be, and make sure you don't dumb down or constrict your value. And that's all I want to say, Sandy.
Awesome, mate. Thank you so much. And thank you to you both for what was a privilege to sit back and listen to you guys go for it. In my mind, I don't think it could be any really clearer, really. The value of advice, it's not sales. Advice is 100% associated with improving lives. And if you do that, then advice is extremely valuable. At Lumiant, our passion is you, your clients, and bringing to life the world's best customer experience platform that supports you in doing what you already do so well. Let's not allow these amazing conversations you have with your clients to live in a filing cabinet. Let's not have your results anchored in a performance benchmark you have no control over. Your clients are driven by purpose. They want to live richly, not die rich. As someone I respect immensely once said to me, the truth is that every single plan ever written is wrong. Your value is not providing certainty when none exists. You can't pretend you know what the market is going to do. You can't pretend that your plan is right, because it isn't. Your job is to change plans, not write them. Your job is to help people make great decisions at turning points in their lives, turning points that happen every 3 to 5 years, and to deeply understand what drives them in life so you can make great decisions that will be life-changing. And we finally believe there is technology that can support you in delivering real advice centered around the client that gives you tools deeply to understand what drives them in life. So if I could leave you with 3 things you should be doing to following up today, apart from ringing Rob, take a step back and look at your current fee model. How are you paid? Is it benefiting you? Are you being paid for the advice you're giving or the products you're selling? Are you charging the right fee, meaning right for the business and right for the client? Are you able to charge for that intangible value of advice and show them its value? Are you charging each client based on their unique circumstances and need? Are you charging to serve them or to sell them? And finally, what's stopping you from changing? What's holding you back? There is a cost to doing nothing instead of taking action. So make the time to change. It will drive better quality revenue, greater profit for your business. The last episode of this series takes place in 2 weeks on the 29th of September. It's our final session, and we'll be exploring how we bring to life the intangible value advice through client experience. Hearing from an advisor who has a passion for delivering extraordinary advice experiences, James Wortley, CEO of Enlightened Financial Solutions. Much like today, the session will provide you with practical steps on to act and what is to act on, what was discussed in our session, and where we discussed delivering the above the line advice. I hope you enjoyed today's session. Please do feel free to reach out to myself or Rob should you have any questions. Thank you for attending. Wherever you are, stay safe, and a massive thank you to Rob and Ty. Have a great rest of your day.
Thanks, Andy, Ash, Ty. Thank you, listeners, as well.
Thank you.